If you have any queries, anything, you can actually write in this chat box over here. Can you hear me presently? Am I audible? Vaishal is typing. Felix. Yes. Okay. Hi, Felix. Hi, Clint, Lilith, Jane. Cool. Okay. So this is going to be the first session, and I know some of you have been trading early in the markets, while some of you are just beginners. Okay, so today's session, the agenda of today's session will be just to have a brief about the markets and like how our course is going to work and how it is going to help you. I guess Lilith has been trading for a while, and Felix, he has some experience in the markets already, right? Yeah, Lilith has been trading from quite a long time, and okay, okay, so yeah, Bijoy is here. Hi, Bijoy. Can you hear me right now? Yeah. Joel can't hear me. Joel, I didn't get you actually. And Chinmay, actually, you can actually log in just from a single user. That is, like you have logged in from two devices. So can I just log you out? Yeah. Can Joel hear me? Okay, Joel has returned now. That's right. Okay, so I guess almost everybody is here and we are ready to get started. Fine. So we can actually start now. And Chinmay, actually, like you can make a single login in the sense you can't basically log in from two devices. There's an issue like that. Yes, like but two devices login was coming. That's why like one was getting logged out. It was popping up for me. That's why. Cool. So we are ready to get started, and it's a Saturday. So some of you are working, some of you are students, and some of you are just people who just graduated. Okay. So and what brings you here is to learn about the stock markets. Okay. So first, let me give you an introduction about myself. So my name is Harry. Okay, you know that. Like I have been trading Indian markets for like last 5 years, and I have been trading the European markets for the last 1 year. Okay, currently I can't also hear. Okay, can't hear. Voice is breaking. Is it fine for others or only Deepesh and yeah? Actually, Deepesh, like if you have a weak net connection or if you are using your mobile, some mobile data issues like this can happen because usually there is no problem. Like most others are not having any problem. So if Joel and Deepesh you're having any issues, it might be due to the poor internet connection or like some issues with the mobile network, something like that. Could you please check that? Because others are not having any issue. So shall we get started? Okay. So I have been trading India markets for like last 5 years. So what I understood from the India markets personally is that like most of the people who trade in India markets are gamblers. Okay, and people usually have this understanding. Like if you tell, okay, I trade stock. If you tell someone that you are a trader, you are a person who trade. Most of them will be having this idea of that you are gambling. Okay, so first of all, let me tell you, stock market is not at all gambling, and but that doesn't mean there aren't gamblers. Okay, so 90% of the people who trade in Indian markets are basically gamblers. So what we expect from you is that like you are not going to gamble. Instead, we are going to use strategies. We are going to use strategies that we have tested in the markets, and we'll be learning those strategies that will help us gain an advantage over the gamblers. That is like if there's 90% people who gamble, most of their money goes to the 10% people. Okay, so only this 10% people are the ones who have studied about the stock markets and who are using strategies. So basically, the stock markets, Indian markets, what happens is that these 90% gamblers they transfer their money to these 10% people who trade using strategies. And we are looking forward to join the 10% club, okay, in the Indian markets. And it's pretty easy to be a successful trader in the Indian markets compared to the international markets. Because in the international markets, there are a lot of people who are experienced and who are using strategies. Okay, so before okay, Deepesh is having some issues with the Wi-Fi. No issues. I'll be sending you the video, so no issues on that. Okay, so we'll be learning step by step. So I know some of you have previous experience. However, like I would like to cover the topics right from scratch. So like in case we have missed out on some concepts that we consider that is really important, we don't want to lose that. That's why we'll be covering the sessions from basics. Okay, at first we'll have a look at this PPT. Okay, so basically, you know that a stock exchange is a place where buyers and sellers meet. That is, in a stock exchange, what happens is that if you want to sell a stock, you don't go to the stock exchange because right now everything is online. Through your broker, through your stock broker, you'll be placing an order to sell a stock that you own presently, and it gets matched with the person. It gets matched with the buyer who wants to buy that particular stock at the price. There will be a negotiation between you and the seller and the buyer. Okay, and the buyer he purchases the stock from you once again through the exchange. So basically, why the exchange is over here? The reason is that let us think about a deal between two friends. Okay, let us assume every all of us have gone to school. Okay, so like let us take this example. Like there is a friend of yours who tells he has a friend who is planning to sell his watch for 1,000 rupees. Okay, and now what you do is you give your 1,000 rupees to the friend, to your friend who is going to give this 1,000 rupees to his friend to buy the watch for you on behalf of you. Okay, so there are two risks over here. The first risk is that either your friend will take this 1,000 rupees on the way to his house, he finds some chocolate, something like that. He spends the money over there, and you lose your 1,000 rupees. Or else the other possibility is that you give this 1,000 rupees to your friend, and this friend gives to his friend who is going to give you the watch. But what happens over here is that your friend pays to his friend, but then his friend doesn't give his watch. That is, his friend actually scams you. Okay, so that is why we have an exchange. Okay, so what a stock exchange basically does is the stock exchange brings in a regulation. That is, when two people meet for a trade, that is, when two people meet for making a buy purchase or a sell deal, okay, a stock exchange may make sure that the person who buys gets the product and the person who sells gives his product to the buyer. That's why a stock exchange is needed. So it is actually a meeting place between a buyer and a seller, and the stock exchange regulates this transaction. And you do the transaction through your broker, because you can't actually directly go to the national stock exchange and give your stock and tell them like sell it for me. That you can't do. Instead, you have a broker involved in between who will be doing the transaction on behalf of you. Like he'll be pushing the order to the market, and that is why we need a stock exchange. Okay, so one word sentence: a stock exchange is a place where buyers and sellers meet. Okay, and it is the body that regulates the transaction. It regulates the transaction in the sense it makes sure that the order takes place and nobody defaults. Oh, Chinmay, okay, it's no issues on that. Just a second, guys. Okay, so we talked about the stock exchange, fine, and now I'll just discuss like what all are the possibilities in the exchange. Okay, so all of you are here to learn about the markets. Many of you are keen towards the investing side. Some of you are keen towards the trading side. Okay, so first thing I would like to say is that like there is a huge difference between trading and investing. We'll come to the topic later. And coming to the opportunities, people prefer the stock exchange. The reason is that there is a plenty of opportunities in the stock exchange to make money. That is like if you know strategies, if you know how things work, that is on what basis the price moves. Okay, so if you are aware of these concepts, it's actually a good place for you to make money. So even if you're a working employee, or even if you're a student or a college student, anything, okay, you can actually you use it as a side, like a side job or a side business, and you can make money. Okay, basically the thing is that most of the people, as I said, like are gamblers, and you can easily gain an edge over these gamblers by applying the strategies that you learn, the strategies that you practice, and most importantly, you need discipline, and you need to have a proper risk management. Okay, so if you are good at these two particular concepts and you got a good strategy, you can definitely make money. Okay, I can guarantee that. Okay, and now let's take a real life example. Okay, okay. So Bijoy Abraham. Okay, let's speak about Bijoy has. Let us assume Bijoy has three friends A, B, and C. Okay, so Bijoy is having three friends A, B, and C. Friend A, Bijoy knows friend A from his school. That is like they used to be childhood friends, and they are still in constant touch. That is, they're still in contact with each other. Like Bijoy has just graduated right now, but Bijoy is in a constant touch with his friend. Okay, so now Bijoy knows a lot about this friend of him, that is friend A. He knows how friend A behaves during his good times, how friend A behaves during his bad times, all these things. Because Bijoy has been observing this friend like from maybe like the last 5 6 years. Okay, so that is friend A. Okay. Now the next friend Bijoy has is friend B. He met friend B during his college days. Okay, they were hostel mates. They were in this. Let us assume they were in the same class, but not in the same room. Okay. So what happens is that Bijoy has seen him for like last 1 or 2 years. He has a good understanding of him, like how he has behaved, how he has changed after he joined college. Because like if you're a school student, like see, I'm not the same person who I was like till school. Like once I entered college, like I have learned a lot of new skills. I have gained a lot of new friends. Okay, all these things. My hobbies have changed. My interests have changed. All these things. Okay, so now this friend B of Bijoy, so he has met this friend B only after Bijoy has joined college. So Bijoy doesn't know what was his background during his school days, or anything beyond what he has seen from the college days. Okay, and Bijoy has a different friend. Like whom he met in a tuition center, something like that, or he some mutual friend C. So this person, he is a friend, but then Bijoy doesn't know much about him. Okay, Joel is having some issues with the connectivity, so I'll be sending you the video. No issues on that. Cool. Okay, so we are talking about Bijoy's friend C. Okay, so friend C is a friend of Bijoy, but Bijoy doesn't really know much about him. Okay, maybe they might have met only quite a few times. Okay, so what I would like to relate over here is that, see, stocks are basically like your friends itself. Okay, so let us assume this A, B, and C are stocks. Okay, we talked the perspective of friends, but A, B, and C are basically stocks. Okay, so if you observe stocks for a duration, like if you observe stocks for a while, okay, if you observe stocks for a while, you'll be understanding how that stock is going to behave under different sets of conditions. That is, if a good news happens to a stock, how the stock is going to behave. If a bad news happens to the stock, how it is going to behave. All these things you'll be observing. Okay. For example, like recently Tata Motors, like Tata Motors had a bad result, like all these things. Okay, so basically you try to understand how the stock is going to behave under a good incident and how the stock is going to behave under a bad incident. Okay, so one basic example let us take of Bijoy's friend A. So Bijoy knows that if something good happens to Bijoy's friend A, he'll be throwing a party. Okay, let us assume he throws a party. He calls his friends. He celebrates. Okay, so next time maybe after 6 months later on, if Bijoy's friend A once again gets some good news, that is like he gets a promotion, he gets a new job, he buys a new vehicle, something like that. He is once again he's excited, he's happy. So the way he is going to behave this time will be similar to similar to the way how he behaved when he received a good news like 6 months back. Okay, so what I mean to tell from this is that trends keep repeating. That is like if a stock has displayed some kind of mood during a good time or a bad time, so the next time the same thing happens, the stock has a really very high tendency to repeat the same trend. Okay, and what we basically look is we try to understand these things. That is like we try to understand this behavior of stocks. Okay, so as a beginner, if you are a beginner, then like it'll be a bit difficult for you because like if you are a person who is going to start off observing the markets from this coming Monday, uh, it's not possible for you to understand how it is going to behave. Like, but you're taking your first step. Okay, so most of you are in your 20s and 30s. Like you still have a long time. That is like within like if you are observing the markets for like a duration of like 6 months, you'll be quite familiar with how most of the stocks move. Okay? And apart from trading, you'll be able to find financially good stocks for investment. All these concepts will be clear to you. So no worries on that. So at first, it applies to mid caps too, 50 to 100 rupees stocks. Okay, so these things are one important thing I would like to say is that like when it comes to trading, okay, when it comes to trading, we usually look to trade the Nifty 50. That is the major Nifty 50. It actually comprises the major 50 stocks in the Indian markets. Okay, so we'll be trading mostly on these 50 stocks. The reason is that much manipulation things are not possible on these 50. Because the market capitalization is too huge and it's not so easy to manipulate these stocks until and unless the promoters they want to do something. Like it's not possible from individual trader side or like prop trading firms or institutional investors to manipulate. So we'll be sticking mostly on Nifty 50 stocks. Okay, and coming to this mid caps and penny stocks, the problem is that like they see their prices bit low, bit not bit low, like comparatively low, and these stocks are actually what do you say are too volatile in the sense like and it's easily to be manipulated as well. That is like if you have some good amount of capital, like people who have like some good people who are trading like 20 lakhs, 1 CR, this range, like big traders, like they are like their sudden trades can affect the price moves, and usually the strategies are not so convenient to be applied in the mid caps. Okay, and one important thing I would like to say is like I have sent all of you some introduction videos about Nifty 50, what is Nifty 50, all these things. So I would like you to have a look at those because that's like very important. Okay, so please have a look at those. Okay, and we'll come. So stocks are like your friend. Trends keep repeating. So the more you observe, the better you become. Okay. So for example, like if you ask me like how my mother is going to behave if I'm going to do something bad, like I have an understanding. I know how she's going to behave because she has behaved badly to me. Like when I did something bad earlier. So if I do something bad again, almost the same way she's going to react, right? So that is why I said stocks are like your friends. So trends keep repeating, and like if you have been noting the market, the global crash like 2008. See if you see the trend right now, like we can expect a financial crisis the next year as well, a similar crash. However, as a trader is concerned, like if it's a crash or like it's still a trading opportunity, you can short sell. And since most of you are young, it's a good time to invest. Okay, like because you can buy things at a low price. Okay, so I'm actually expecting a crash coming year. Okay, just looking at the graphs, looking at the trends, the LIBOR ratings. So don't get confused. Like, okay, so now we'll switch to. So we know that like when stocks get listed on the stock exchange, the first thing you do an IPO. So IPO means initial public offering. Okay. So if I have a firm, suppose like let us say LLNet. Okay, I have an online pharmacy LLNet. So suppose I want to list my online pharmacy. I want to go public. Go public means I'm going to list like right now it is a private limited firm. Okay. Yes. Yes, we'll do that. As Clint has asked, I'll be doing that, but that'll be in the next session. Okay. So before that, I would like to discuss about some concepts. So once I cover these concepts, I will go to this deeper technical things. Fine. Okay, so suppose I want to raise money for my online pharmacy. That is, maybe I want to expand to the international markets. So I want to expand to the all India level, pan India level. So I want to raise funds. I don't have enough money to set up retail outlets. Okay, so I need to raise funds. So that is one reason why I go public. So going public means we list our stocks on the stock exchange for raising money. So that is what is meant by going public. Okay, and one more reason why I go public is that okay, so I told you I have a pharmacy, and I'm going to try a new business model that has never been tried out. Okay, so to try that new business model I had to risk a lot of money. Okay, I'm just giving you examples. That is like let us take right now the valuation of my firm is 10 cr, and I want to enter into a new business model. What like for stepping into the new business model, I need to have another 5 cr. I have 5 cr with me, but then I don't want to risk that 5 cr of mine because I don't know if this new business model will work out or not. So what I do is that I need to divide risk. So one thing I can do is that 2.5 cr or like 2 cr 3 cr I can raise from my side, and another 2 cr I can actually go for raising funds through the IPO. Okay, so this 1 cr 2 cr and all, like this is just a value for explaining you. So when it comes to IPOs and all, like it's thousands of crores that is being involved. So this is just for explaining things. Okay, so don't take it too technical. And that is one another reason why firms go public. That is to divide risk. Okay, because now what happens is that just 2 CR is from my side, and the rest 3 CR is from the public. So if something happens to the new business model, all I'm going to lose is 2 CR, and the rest 3 CR, not lose, like the rest 3 CR has been raised through public funds. And if the business fails, obviously the value of the stock will go down, but then my exposure will be less. My exposure will be less means how much I'm going to be impacted. That is same thing. Let us assume I'm going to start a new business alone, and the second case I'm going to start a business with two partners. Okay, so when I'm starting with two partners, if the business fails, that means the capital raised, the risk involved is being divided by the two partners. So the same thing happens with an IPO. So in the IPO, the difference is that you are not directly getting involved in the business, but you are owning a share of the company. Okay, so the businesses that the company do, it depends upon the management. But then, if something bad happens, you are going to get impacted because the prices of the shares will come down. And if the company, what do you say, shuts down, you lose your money. There's that possibility also. Okay. And one more thing is liquidity. Okay, so I told you, okay, I have a pharmacy that is worth like 10 CR valuation, but the valuation of the company is 10 CR and it is generating good profits. That is, maybe it is generating like 5 lakhs, 10 lakhs per month. Okay, so now the thing is that I know the valuation of the company is 10 CR, like it is generating 10 lakhs per month. Now, all of a sudden, I feel that I need to what do you say? I need to switch to some new business. That is, I need to venture into new industries, and I need to raise some money. So one thing I can do is that I can't tell that I have a company with 10 CR valuation. So there is no use in that. It's actually what do you say? It's not liquid money. That is like I can't use that 10 CR for anything. So what I do is like maybe 1 CR worth of stocks I will issue to the public, and through that 1 CR I will raise the capital, and this 1 CR that I get, I'll be using for investing in some other business. All these things. Okay, so that is what you consider by liquidity. Liquidity means, okay, let's take, okay, there's this mobile of mine. Okay, this is a Galaxy J6 Plus. Okay, so this J6 Plus is worth some 15K, 12K something. Okay, so now if I say this is worth 15K, okay, okay, second hand, let's take is 10K. Okay, now if I have this phone with 10K, this 10K I can't use in any way. So what I do is, if I need 10K, I need to sell this phone, right? I need to sell this entire phone to get 10K. Then I can use that 10K for some other purpose. Similarly, liquidity means like it is the ability to raise funds through the asset that you have. That is what you know as liquidity. Okay, and this equity, when it comes to equity is share market, capital market is all linked to the stock market itself. Okay, equity, share, stock, everything is basically the company's share. Okay, so don't like some of you might be having that doubt. Okay, so basically, firms go public for liquidity as well, and the fourth one, responsibility. Okay, and can someone give me this example? Okay, let's make the session a bit more interactive. Like, so only Clint is having doubts so far, and Lilith has also asked me a doubt. Okay, let's make it more interactive. Okay, can you give me an example where a firm went public to get rid of responsibility? Okay, I am pretty sure that all of you over here have used this firm's help for purchasing something. Okay, just tell me an example where a firm went public to reduce responsibility. That is when one of the partners felt, okay, I'm fine, it's time for a retirement, or I want to switch to some other business, I want to do something much more interesting. Like one of the partners, he quit from the firm and they went, okay, they didn't actually go public. They sold their shares to one different firm. Okay, and it was an international firm. They acquired majority of the shares in this firm, and one of the partners quit because he wanted to exit from his responsibilities. Can any one of you answer? Any one of you over here? Okay, Vaishak is typing. Lilith was also typing. Yeah, Flipkart. Okay. Yeah, exactly. Yeah. Okay. So that is one another reason like why firms go public. Okay. So let us assume that you made a company. Okay. You made a company. You have worked for like some 40 years building the company. And at the end of 40 years, you realize that, okay, I'm done with making money. I don't want. And maybe your children are not that interested in business. They want to pursue some other career. Yeah, Flipkart, right answer, yes. So Flipkart, like one of the partners, what has happened is that he was done. He wanted to go into he's an angel investor. You know, he's funding startups, all these things. Yeah, he was done making money. He wanted to do some other things. So he exited his uh, shares. Okay, he handed over majority of his shares. Okay, so that is one of the reason why firms go public. That is, they want to hand over the responsibility. Okay, so this is one of the best examples. Like they sold majority of their shares to Walmart. Walmart, they were looking for a penetration in the Indian markets, and they easily got it by acquiring majority of the shares in Walmart. Okay. And another reason is exit. So exit is actually is the correct thing with Flipkart. One of the shareholders, only one of the person exited. Let us assume if both of them exited, it was a perfect exit case why they went public. Let us assume, like earlier we were speaking of this condition, like where I have worked for like 40 years building my company, and at the end of 40 years, I feel I should do something else, should do maybe some public service, something like that, and maybe my children, they are not interested in carrying forward the business, or they are not at all interested in this business, or else maybe I don't have kids like that also. Okay, so what they do is they exit from the firm. That is by going public. All the shares are sold to some other people. That is one another thing. Okay. Okay. Then why it is an opportunity for like I am pretty sure most of the people who are attending the seminar over here have a entrepreneurial mindset. That is like you want to do something on your own. Okay. You like people who trade, the thing about them, something that is special about them is that you actually be your own boss. That is your actions and what do you say, the money you make, the profits you make, all these things actually depends entirely on your efforts and your hard work. Okay, that is, you are not working for anyone else. And the stock market, the advantage of this is that like even if you have like 100 rupees or 500 rupees, you can actually get into this business. It's like not a business, you can get into the trade. You can trade. The profits that you make depends on the work and efforts that you put in. Okay, so that is the thing about this field. And let me tell you one very important thing. Okay, this is going to make you happy. Okay, so if you trade stocks, okay, it's proven. Okay, if you trade stocks, you are utilizing your brain. Okay, that is what usually happens in a regular 9 to 5 job. A regular 9 to 5 routine job, if you're following a regular 9 to 5 routine job, you're doing the same things over and over again, and you are not making maximum utility of your brain and your mind. Okay, and but when you do trading, that is when you trade stocks, when you read all these things, you are actually utilizing your brain to the full potential. You're using your brain to the full potential. You're activating each and every place, each and every nerves in your brain. Okay, so what this does is that it decreases the chances of Alzheimer's. Okay, it's too young to think about these things. Okay, but then it really impacts your mindset. It really impacts your brain. You become more sharp. You become more, what do you say? Can become more focused. All these things. If you see most of the hedge fund managers or most of the traders who have made it big, like, you'll be knowing like they are smart people because they are exercising their brain every day. They are exercising their brain to the full potential. Okay, uh, risk is involved. All these things are involved, but then you are exercising. Like you start losing your hair. All these things will happen too, but then like your brain is getting active. activated every single day. Okay, so be happy about that and forget about that. Okay, now like one another thing I told you about the mindset you people have in common, right? So when it comes to an individual, it is actually kind of really easy. Like maybe now we'll be thinking like almost every one of you must have had an ambition. Oh, if I was Mukesh Ambani, okay, that is like if I had started Reliance like 40 years back, where would I have been right now? Okay, so right now starting a Reliance from scratch, not Reliance, a company similar to Reliance, right from scratch is a bit difficult. Okay, a bit difficult in the sense like not just difficult, it's actually kind of impossible too because expenses have gone up, all these things have gone up, and it's not the right time to enter into the petrochemical industry, all these things. Okay. However, what you can do is instead of building a company from scratch, you can own a share in the company. That is, if you own a share in the company, you are becoming a part of the company, and if the company makes profits, you'll be receiving a profit share in the form of dividends. Okay. So dividend. Okay. Now I'll explain about dividends. So let us assume I have a company and the company has made 100 rupees profit in this quarter. Okay, in this quarter, the company made 100 rupees profit. Okay, a quarter means 4 months. Okay, you're familiar with it. If you so usually a financial year is usually divided into 4 quarters. Okay, and let us assume our company made a profit of 100 rupees in this particular quarter, and there are 100 shareholders. So what happens is that the company decides to divide the profits and give each shareholder his or her profit share. So that is what is known as a dividend, and each individual shareholder receives 1 rupee profit. So that is what we call as a dividend. Okay, and one more thing about investing or trading is that like you enter and exit as you wish. See, if you are starting a company of your own from scratch, like it's not it will take some time for the company to generate profits, and it will it is not easy for you to exit from the company. You can't actually easily sell your company like you sell a car or you sell a phone, something like this. So quite a difficult process. Okay, so that is one more reason why we should trade or invest in the markets. Okay, and most importantly, under present scenario, is that like we know that if you put money in bank for FD fixed deposit, you get like 7% interest rates per year. Okay, so have you wondered how much returns you get in a country in a developed country like US, okay, Switzerland, all these places? Okay, so when you look at these what is it, the European countries, most of the countries they either provide a very less interest rate or like 1%, 2%, and there are countries like Netherlands, where Sweden, where the interest rates are negative. That is, if you put money in the bank, you have to pay money to the bank. Okay, that is, if you put 1,000 rupees, if the interest rate is negative 2%, that is, at the end of the year, you'll be having to pay 20 rupees to the bank. Okay, instead of getting interest for you, you will be paying interest to the bank, because like when developed countries are concerned, they don't need any money. So if you park the money in the bank, you have to pay interest to the bank, and you have to pay a fee to the bank for storing your money. So it's basically just like a locker. And under current scenario in India, like we are getting like fixed deposit 7%. But then, like if you look at the inflation rate, if you look at, let us assume we are getting a fixed deposit returns of like 6.5%. Like let us like, and the inflation rate is usually like 3.5 to 4%. Okay, so what you effectively get is like just 2 to 3% per year, because inflation. Like if you don't know about inflation, I'll just explain the concept right now. Let us assume like okay, let us assume I bought this phone for 100 rupees last month. Okay, now after 1 month, after 1 year, the price of this thing, like for buying the same thing, like maybe the price will go up. Okay, this okay. Let us assume this phone is still the latest phone of Samsung after 1 year as well. Okay, so I bought this latest phone like 1 month back for 1,000 rupees, and now after 1 year, the price of this from 100 it has gone up to 104 rupees. So that 4 rupees rise is what you known as inflation. Okay. And speaking about bank returns, like see, usually our inflation is eating up most of the returns that we get. That is effectively we're getting just 2 to 3% of 2% 2.5% of what we deposit. That is because India is developing right now, but we can't say for how long we'll be getting this 2%. Maybe after 5 years, or maybe after 6 years, 10 years. What if we to start getting negative interest rates like the European countries? Okay, so then it will be a high time for us to think for methods where we can park our money, which gives us better interest rate. And stock market is one of the best tools, like apart from solid gold, real estate, all these things. So what is better, trading or investing? Because in long race we all are dead. Yes. Okay, that's a very good question, Lilith. Okay, so see, I'll explain you this thing. So first of all, what matters the most over here is like you should trade, you should invest, you should do both. Okay, you can't stick on just to trading, you can't stick on just to investing. Okay, the reason I'll tell you. Okay, okay. So I'll mention my personal experience. Okay? I have been have done wealth management for a firm. Okay, so that firm is presently handling nearly 10,000 crores. 10,000 crores of assets is being managed by the firm. Okay, so what that firm does is that 90% of the capital that firm uses, like it's an Indian firm. Okay, so the 90% of the capital, that is 90% of the capital, like it's basically a PMS service. Like it provides wealth advisory and PMS services. So 90% of the capital that is with the firm, that the firm has got with from the clients, is invested in safe, much riskless instruments like debt funds. What do you say? Debt funds, gold, government bonds, another other sovereign bonds, all these things. Okay, so 90% of your capital, like it is preserved safely in low risk things like bonds, all these things. Okay, and the rest 10% is what they use for risky investments like mutual funds, trading, prop trading, all these things. The rest 10% is what they use for risky investment. So what we can guarantee in this case is that we know that 90% of our capital will be preserved. Okay, 90% of our capital will be preserved no matter whatever happens. 90% will be preserved. Okay, and the rest 10% is that you're going to park in this risky things. Okay, so what happens right now is that, like, 90% will be there, and this 10% you are ready to lose, you are ready to risk. But this 10%, usually what happens is that this 10% will bring you more returns than the 90% that you have parked. Okay, let us take 1 CR, okay, 1 crore. So 90 lakh rupees is being invested in safe classes, safe asset classes, and 10 lakh rupees for risky things. Okay, let us take trading. So this 10 lakh rupees is capable of bringing you more returns than the 90 lakh rupees that you park in safe instruments. Okay, so the more risk you take, the better returns you can bring. Okay, so but the risk that you can afford to take should be decided by you. Okay, so that is the first and foremost thing that I tell all my clients. Okay, I usually don't tell in the first session, but since you asked, so the risk that you can take should be decided by you. Okay, the risk that I can take might not be the risk that someone else takes. So I see it varies from person to person. However, is more or less the same. Okay, so it is likely trading might help to build the capital. Yeah. See, if you look at Warren Buffett, he just have a investment portfolio. But if you look at people like Rakesh Jhunjhunwala, he has both a trading portfolio and he has an investment portfolio both. So the best thing to do is you have a diversified portfolio. That is, you invest as well as at the same time you trade as well. Because trading involves higher risk, but you're capable of bringing much better return. Okay, see, we have clients who are making like trading with 10k capital, they're making like 2k 1k per day. That is like they're making like 10% to 20% per day. The risk involved is higher, however, the returns are higher. So these people who use 10K, they know that they are performing risky trades, but then we'll be covering risk management measures, which uh, helps you manage your risk profile. Okay, that is like on the overall, you will always end up in green. Okay, I'll tell you one basic example. We are diverting too much from the topic, but since you have asked this really good question, I'll give you one basic example. Okay, so let us take an example that you buy a stock. So if you buy a stock, the probability of the price of the stock to go up or down is 50-50, right? That is, if you buy, the probability that the price goes up or down is 50-50. That is based on basic statistics. If you perform two trades, one should be a winning trade and the other one should be a losing trade, right? Just based on statistics. Okay, and if you're performing 10 trades, like based on probability, you should have 5 winning trades and 5 losing trades. Okay, and we'll be using strategies to get entries. We'll be using strategies to get entries, which will easily increase your success ratio to like 75 to 85%. That is like if you're performing 10 trades, like 7 to 8 trades will be winning and 2 to 3 trades will be losing. So in 7 to 8 trades, you'll be making money, and the rest 2 to 3 trades you'll be losing money. But on the overall, you are still in profit because you have made 7 winning trades and 2 to 3 losing trades, right? So you are on the winning side. So trading involves science, it involves statistics. So all the strategies that we train you are actually based on back-tested data, like it's based on probability, like uh, it's entirely based on probability. We have worked on previous data, prehistoric data. We have checked out how strategies work. Based on that, we have formulated our strategies. Okay. Okay. We'll go to the next slide, and please watch all the videos that I have sent you. Okay, and okay, we'll be discussing about these topics, but okay, have a look at those videos as well. Okay, so basically there are two exchanges. There are two major stock exchanges in India. That is, first one is Bombay Stock Exchange, and the second one is National Stock Exchange. Okay, Bombay Stock Exchange has nearly 5,000 listed companies present in it, and National Stock Exchange has 1,000 companies listed in it. Okay, however, for trading purpose or investment purpose, I personally use National Stock Exchange because the reason is that the volume of trades that is happening in National Stock Exchange is much higher compared to Bombay Stock Exchange. Okay, the volume is much higher in National Stock Exchange compared to Bombay Stock Exchange. Okay, now you'll be having this doubt: what is volume? Okay, I'll give you with a real life example. Okay, okay. See, volume means the number of transactions that is taking place in an exchange. So the higher the volume, the better it is. Because like let us assume I am a person and I want to buy this. I want to sell this mobile at 100 rupees. Okay, so I go to the market. I go to a market and tell mobile market and tell I want to sell this for 100 rupees. Okay, and now there is just another guy. There is just a single person in the market who has come to purchase a second hand mobile, but the price that he is willing to buy is at just 90 rupees. So he said, I want to buy this mobile at 90 rupees, but I am here to sell at 100 rupees. Okay. So I'll be disappointed. That is, there is nobody to buy my mobile at 100, and maybe I'll sell my mobile at 90 rupees, or maybe we'll negotiate, like we'll fix at a price of like 95 rupees. The person is asking at 90, I'm planning to sell at 100. So we'll reach a price of like 95, and I'll hand over this mobile to him. Okay. Over there, the volume was just one. Okay. Now, let us assume the next scenario that when I went to sell my mobile, there were like hundreds of people who came to buy second-hand mobiles. Okay, like everybody wanted to buy my mobile. Okay, and I am asking a price of like 100 rupees, but I see that there are a lot of people willing to buy my mobile at 100. So I feel okay. Then I should put the price at 101 or 102. Then I ask, okay, 102. Okay, so there are hundreds of people over there. Okay. Okay. Let us take. Okay. I'll give you one more example. So let us assume there are only 10 people this time. So these 10 people are planning to sell at 100. Okay, there is a guy who is willing to buy at 90. There is a guy who is willing to buy at 95. There is a guy who is willing to buy at 97. And finally, there's a guy who is willing to buy at 90, 100 itself. So I came to sell at 100. So since there is the best person who is planning to buy, the best case I'm going to get is 99 rupees, right? 100 rupees, right? So I sell to the person who's willing to buy at 100. Okay, so I was happy because I was able to sell at 100. Okay, now let us take the next case when there are like hundreds of people willing to buy my mobile. I came to sell at 100, but then I feel there's a sudden hike in demand for this particular mobile. Everybody wants to buy this. Okay, then I feel okay, I should raise my price to 102. I keep my price as 102, and still I'll be able to. I came to sell at 100, but I was able to sell at 102. Bonus for me. 2 rupees bonus for me. Okay, so that is the next case. So that is why volume is important. Okay, in this case also the number of transaction is just one. Okay, number of transaction is just one and volume is one. Okay, but the number of buyers and sellers, that is the quantity. The overall number of trades that is happening in National Stock Exchange is much higher than Bombay Stock Exchange. That is why we prefer to trade or invest using National Stock Exchange, because we always get a fill at our desired price. Okay, now we'll see two websites. First, Money Control, and after that we'll go to nseindia.com. We'll be seeing this volume. We'll be seeing on the thing itself. Okay. So far all good. Oh, so far do we have any doubts? Higher the volume, higher the liquidity. Yeah, exactly. It's much easier to cash out when the volume is high. See, let us take the worst case. I came to sell this mobile at 100. Nobody is there to buy. What will I do? It's illiquid, right? Yeah. So higher the volume, higher the liquidity. Exactly. So do you have any doubts like Chinmay? Like, are you having any doubts? Bijoy, Chinmay, Clint, Felix, Jane, Joel, Lilith, Vaisha. Like, do you guys have any doubts right now? All clear. Cool. Lilith has been trading from quite a long time, I guess. Yeah, so no doubts. Felix, no. Fine. Vaishak, no. Shall we move forward then? Okay. So then we'll see two websites. Okay, so these are like really important websites I have written down over here. Before moving to the website, just write down these websites somewhere, like moneycontrol.com, Bloomberg. You might have heard about Bloomberg, I'm obvious. And apart from that, nseindia.com. Okay, we'll see that. Okay, so just write down like these are two. Like most importantly, money control. Like for India markets, money control is like your best friend for India markets. So you're going to have a look. You're going to download the mobile app. You're going to have a look at this site quite often if you're planning to trade. See, we have a lot of people who take membership, but they never bother to trade. They attend the first session, they feel okay. I'm not apt for this field. I'm not a person who is going to be committed. They quit. Okay, so never quit. It's like it's worth pursuing. It's a field worth pursuing. Okay, so this is one. These are two important sites that you need to have a look at. Money control. So now we'll switch to the websites. Okay, you need not do anything. I'll be moving to the website. I'll be sharing my screen. Just a second. Okay, so I hope you're getting my screen right presently. Are you able to see my screen? You just tell me. Yes, you're able to see my screen, right? Okay. So cool. No. Yeah, Lilith is able to see. Everyone is able to see it, right? Yeah. Okay, fine. Vijay is not able to see the screen. This is still loading for you. Vaishak is able to see. Okay, Bijoy, just try connecting again. Oh, this is still loading for you. Okay, so this is a really good site. Even this is owned by Reliance. Okay, so this is a really good site for watching news related to the stock markets. Just a second. Yeah, the advantage of this website is that you get to know a lot of things related to stock markets. Apart from stock markets, global news, what is happening with the government, what is Trump speaking, what is happening with the cricket, everything, celebrities, everything you get to know over here. Okay, so the celebrities and cricket doesn't matter to us. However, what matters to us is things related to the markets. Okay, and this is going to be a good friend of ours. We are going to catch news related to markets over here. Okay, like you will get articles. Okay, sad thing to know about this coffee day. You get things related to like what is happening with the Indian indices. Okay, like is there anyone who hasn't watched the videos? Is there anyone who hasn't watched the videos that I have sent you? That is like you still don't have an understanding about Nifty 50, Sensex 30. Is there anyone? Is there anyone over here who hasn't got an idea about NSE, BSC, Nifty 50, Sensex 30, Nifty 50, all these things? Is there anyone? Can you please type? Let this typing. Are there Lens CNBC? CNBC Avas? I'm not sure about that, but then like CNBC Avas, like it's not at all reliable. Okay. See, news is important, but we are not going to depend entirely on news. That is, we are not going to trade just based on news. Okay, let me tell you something. See, the news we receive, right? That is the news the public receives. That is like the news that we observe in this money control, all these things. Okay, before this news is being published in these websites. Okay, it actually reaches institutional investors and big traders. Like there are services, there are paid services like Thomson Reuters, okay, JCW, all these things. There are many paid Reuters services where we get all this news before it is being told to the public. Okay, so the bad thing about trading entirely based on the news is that when we enter, we will be entering late compared to the people who entered before us. That is the big traders, the institutional investors who have this personal contacts, who has this Reuters service, paid Reuters service, all these things. Bloomberg services like it's like 10 lakhs per month. So people who have these services, they'll be entering the trades much better, much earlier than you. So you be actually in a suffering condition when you trade late. Okay. However, like this site is really important for observing news that is related to the market. So, let's see some important news. Okay. Okay. See, there's something over here. Mumbai rains live. Red alert issued. Heavy showers predicted in the next 24 hours. Okay. So we see a news like this. Okay. This was issued at 4:33 p.m. August 3rd. Okay, so there is a red alert. Heavy showers have been predicted in the next 24 hours in Mumbai. That is, what happens if heavy showers happen? Okay, like rainfall is important. Rainfall is important for agricultural industries. That is like you get good yield only if there is good rains, right? So rainfall is important. But then what happens if a flood happens? If a flood happens, crops die, farmers lose money. Okay, see, many of the people in India still, not many, most of the people in India are still dependent on agriculture, okay, and their income decreases. So, what happens if income decreases? Okay, first let's finish. What happens if it rainfall is good, but heavy rainfall that leads to floods? What happens? Is threatening. Okay, when heavy rainfalls like Mumbai, as you know, is actually an industrial area. So what happens if heavy rainfalls happen? Okay, So the logistics chain in the area will be affected. If there is agriculture in the area, that will be affected. If agriculture gets affected, obviously the company that is manufacturing fertilizers will get affected. Okay, and their profits will decrease. Farmers, they lose their crops. That means their income is decreasing. If income is decreasing, what will happen? Their expenditure will also, they'll try to cut down. So, uh, okay, one direct industry. Okay, all these are just general topics. Okay, just general discussions. See, we have not actually got into our session still now. Okay, we have not got into the strategy. This is actually a introduction session. So don't think the coming sessions will be similar to this. This is just to get familiar with the markets. Okay, hope you got an understanding of that. So from the coming sessions onwards, it will be based on strategy, based on conditions, market conditions, strategies, all these things. So this is just a introduction session that we interact with each other, just to brief about the market. Okay. Okay, we were talking about this rainfall, right? Now you know this FMCG industry. FMCG means fast moving consumer goods. In the sense like this creams, soaps, shampoo, exactly. Let it say shampoo. Okay. So all these things are coming under FMCG. So the first thing that like if a person starts earning more, his lifestyle will increase, and the first impact will happen in FMCG industry. So obviously, if if like in college and all, like when we were in college, we used to cut down on our expenses because our expenses are being paid by our parents, and we need more money to spend for our personal needs and all. So we cut down on our expenses. So we cut down by using cheap shampoos, like using cheap soaps. Okay, uh, like cheap soaps in the sense those are priced lesser. Okay, and now when you start earning, when you start making money, you go for better brands. First, you choose soaps, high-end soaps, Yardley, high-end soaps you choose. Then after that, you switch to shower gels, okay, which are more expensive. So FMCG is an industry where it directly is involved with your this thing income. So if farmers make less money, that is their crops are being affected by floods. What happens? Their lifestyle decreases. So if they were using like high quality products earlier, expensive products, they'll switch to lower quality or lower grade products. Obviously, I'm just giving an example of how things are interrelated to each other. Okay, so that is why like we observe news like this. Okay, this is a prediction for the next 24 hours. Okay, so anyone from Kerala over here? Yeah, Bijoy is from Kerala. Felix is from Kerala. Okay, so if you were Vaishak is also from Kerala. Okay, so if you are from Kerala, then Jane is also from Kerala. Okay, so if you're from Kerala, you must be knowing that like what has happened like last year, almost like this time only, when floods came, like entire economy of Kerala was affected. The reason is that floods happened, like many people, they were not able to go for jobs, all these things. Okay, so when things like that happen, it's like really bad for the industry, and what do you say, like all negative things happen. So that is how everything is related to each other. And one major thing is that this petroleum industry. So whenever you must have observed that whenever the price of crude oil increases, our petrol price increases, because like we entirely depend on importing crude, mostly from Iran, okay, Gulf, all these places. So as the price of crude increases, our expenditure increases for importing, and hence the price too increases. Okay, so that is one example how things are related to each other. So I would like you to have a look at this Money Control website. Just read through all the news. Okay, just read through all the news, and don't look at commodities, currencies, bonds, and all for now. So then go to this market section. If you go to this markets, you get things related to the stock markets, and after that, go to this like this place in indices. If you see the indices over here, Nifty 50, It is the weighted average price of the 50 stocks in India. Also to the National Stock Exchange website. So these are the companies that is coming under Nifty 50. Okay, as you know, Mahindra, Mahindra, Tech Mahindra, HDFC, all are familiar names, all are household names, because they are the big 50 companies in India which is capable of determining the overall trend of the market. So if somebody tells in the news that Nifty is up by 17 rupees, that means what we understand is that Nifty is an index which is composed of these 50 companies of top 50 companies in India, and there has been an upward move in these top 50 companies that resulted in the overall Nifty going up. Over here, you see these advances and decline 25 advances, 25 declines. That means 25 companies, the price of 25 companies moved up. Last trading day was Friday, 25 companies moved up and 25 companies moved down. That is what is being meant by 25 advances, 25 declines. And this 10,997 is the average weighted average value of the 50 stocks based on market capitalization. Okay, this term market capitalization is very much important. I'll show you that. Okay, so that is what is known as Nifty 50. Over here, you see this change 17.4. That is from opening, it increased by 17.4 rupees. So the opening price was 10,997.4 minus 17.4, that is 10,000. 10,970. Okay, so sorry, 80. So from 10,980, it increased by 17.4 rupees. That is, it changed by 0.16 percentage last day. Okay, so that is what you mean by this. And if you look at Sensex, Sensex is for Bombay Stock Exchange. It is the index of Bombay Stock Exchange. It is the weighted average price of 30 companies in BSE. And over here, the price is 37,118. 30 companies over here. So basically, there is a formula for calculating Nifty 50 and Sensex. However, you need not worry on that because you readily get it. Over here, the price has increased by 99.9 rupees from previous day's opening. That is a percentage change of 0.27 percentage. Okay. Do you have any doubts so far? Like, does anyone have any doubts so far? Like, so far, so good. Or you have any doubts? Please let me know before we move forward. Okay. As Mark, note down this website, National Stock Exchange of India. So this is one website you're going to have a look at daily. Be having a look at this website every day, every single day to see how the market conditions are. And I suggest that you download this Money Control mobile app. There's a mobile app for this. If you're an Android or an iOS user, there's a mobile app. You get live updates regarding stocks, everything. All clear, all clear. Okay. Does Chinmay has any doubt? Chinmay, Chinmay, Flynn is not having. Nobody's having a doubt. Okay. All clear. Yeah. Okay, cool. Then we'll switch to the next things. Okay. So we were speaking about this volume thing, right? Now I'll show you the volume. So if you take money control site, okay, and just click on any stock. See SBA, the price of SBA moved on by 8.7 rupees last day. Let's take the site. Let's take this SBA stock. Okay, now let's see the volume. Okay, See, this thing that is being shown in 308.45 is the price of SBI stock. 308.45 is the price of SBI stock. Over here it is Bombay Stock Exchange. Over here it is National Stock Exchange. In Bombay Stock Exchange, the price fell by 8.75 rupees. In National Stock Exchange, the price fell by 8.7 rupees. Now, if you see the volume over here, it's 2.9 million in Bombay Stock Exchange, while the volume is 64 million in National Stock Exchange. So that's why I said like we always prefer to trade in National Stock Exchange. The reason is that the volume is much higher in National Stock Exchange. Okay. So this is the 308.45 with the current price. 315.55 was the price when how price opening price of stock State Bank of India, and the closing price of the previous day, that is on Thursday, the closing price was 317. Okay, so this is the opening price, and we have discussed about all these terms in the video. So please have a look at the video to get an understanding about these things, whatever is being mentioned over here. So bid price, offer price. Okay, as the name itself suggests, like at 308.45 price. Okay, at 308.45, there are like 4,353 people who are willing to sell at 308.45. This was at the closing time. Okay, so these orders didn't get a match. So when the market is live, these apart from the opening price and previous closing, this bid price and opening price keeps varying. Okay, so this is because bid price is the price at which people are willing to are bidding or willing to buy, and offer price is the price at which people are willing to sell. Okay, so this varies during the market hours. Okay. So then one more thing you can like one more advantage of this thing is this website is that you can get the chart of the stock that you're looking at. This is the chart. Okay, so all these things have been explained in depth in the videos. So personally, we won't discuss much about this. Okay, so this is the chart basically, candlestick chart. Okay. Okay, so uh, who asked me this question? Trading and investment. Okay, Lalit asked me, right? Okay, so whether you do trading or investing, you should do both. Okay. Like, there's the saying that you should not put your all your eggs in the same basket. So basically, that is the principle. You should the profits that you make through trading, you should actually invest. Okay, and most of you are young. Okay, most of you are really young. So, so like if you start investing, is a gradual process, and trading is like you for profits soon. Okay, for now, I'll like to say about an example of a mango tree. Okay, so a person who plants a mango tree is basically an investor. So what he is doing is he brings a seed, he plants the tree, he waters it daily, he waits for like 5 years, 6 years, 10 years, 20 years for the tree to grow huge, to generate mangoes, all these things. So he is ideally an investor. So people usually have a misunderstanding between investing and trading. Okay, so a person who plants a mango tree, he is the one who is an investor. So he plants the seed, he waters it, he has a long-term approach. So that is what you mean by investing. Okay, so by investing, you're being a part of the company. Okay, you're being a shareholder in the company. You are expecting the company to grow over the years. So that is what you mean by investing. And Coming to trading, let us take an as example, like my grandfather planted a mango tree like 10 years back. Okay, like what I do is, whenever I visit my grandfather, I plug the mangoes. I plug the mangoes and use it for myself. Okay, because I see that there are mangoes over there, and I know he's my grandfather. So even if I pluck the mangoes, he's not going to tell anything. So I personally make use of the mangoes that my grandfather has planted long back. I utilize the opportunity of plucking it and having the sweet mangoes, because I know that my grandfather is not going to shout at me because I'm his grandson. Okay, so that is what a trader does. And let us take the other way around. I plug the mangoes. I plug the mangoes from my grandfather's mango tree. Then I sell these mangoes in a market. I sell the mangoes for money. So in that aspect, I'm a trader. That is, I make use of the opportunity. Okay, so to make things much better, let us assume the price of mangoes is 10 rupees per mango. Just an example, 10 rupees per mango. So in the market, the price is 12 rupees per mango. So my grandfather planted this mango tree which is having a lot of mangoes now. So I go to my grandfather and tell him that if my grandfather gives me these mangoes for 10 rupees, I will buy those mangoes for 10 rupees. So my grandfather will be like, okay, fine, you can take for 10 rupees. Then I take these mangoes that I bought for 10 rupees and I go and sell in the market for 12 rupees. Okay. So effectively I'll be having 2 rupees profit, because I bought the mangoes for 10 rupees and I'm selling for 12 rupees. I'm having 2 rupees profit. So that is what you know call as trading. So trading is basically you make use of the opportunities. That is, you make use of news, you make use of technical analysis, you make use of the strategies that we train you. So the strategies that we train you, like when it comes to trading, we'll be looking at, like we saw this candlestick charts, right? These, okay. One second, I'll just show. Okay, we saw these charts, right? Okay, so these charts are basically what's the time frame? Okay, yeah, these charts are 1 day charts. Okay, the charts that we are looking over here are 1 day charts. So if you want, like each candle represents a particular day, a single day. Okay, so when we are trading, we use each candle, like we use like 5 minute, 15 minute, 10 minutes charts. That like each candle will represent 10 minutes of the entire day. And if you know that our market opens at 9:15 and it closes at 3:30, the equity markets opens at 9:15 and closes at 3:30. Okay, so what we do as traders is that we use technical analysis, we use charts, we find how the stock is moving, we find the trend, and we trade with the trend. That is, if we feel the price is going to go up, we buy today and we are going to sell on the same day itself. That is, like if the price is 100 rupees now, we buy at 100 and we sell at 101. Okay, so our profit is 1 rupee. And when it comes to investing, maybe I'll buy at 100 today. I feel that okay, this company is going to grow over the next 10 years. So I invest 100 rupees today. Maybe after 10 years, I'll be sell. Maybe after 10 years, the price is 101. Oh, sorry, after 10 years, maybe the price is 110. I'm going to sell the stock for 110. 10 rupees is my profit. Or else maybe luckily the price of the stock is 200. I'll sell for 200 rupees. So that is the difference between investing and trading. So trading is basically based on speculation. That is, you speculate the move of the market. And the most important thing about trading is that when you invest, you're putting your money in something, you're being part of the company. Okay, you feel the company is going to grow over the next 5 years. So you're going to stay invested in the company for the next 5 years. But when it comes to trading, uh, like usually the strategies that we teach are basically for day trading. That is, when you trade, you enter the stock and exit from the stock on the same day. That is, if you feel the price is going to go up, you enter the stock Okay, you make some profits, then you exit also on the same day. From 100, you buy at 100, you sell at 101, and you exit. Okay. The advantage of trading is that you got an option to short sell. Short selling means you sell something that you don't have in hand. Okay, so you'll be having this confusion. How can I sell something that you don't have in hand? Okay, I'll explain you. Let us explain once again with the real-time example, like Punjab National Bank. Okay, so this when this Nirav Modi case came, like it was announced like in the evening hours. That is that Nirav Modi has taken a lot of money from borrowed a lot of money from Punjab National Bank. All these things. So when the Nirav Modi case came, so we were really sure that the next day the price of Punjab National Bank is going to go down. Okay, so if you had positions in Punjab National Bank, that is, if you had invested in Punjab National Bank earlier, you could have sold off at the beginning of the day, or else as an investor. But as a trader, what you could have done is you are sure that the price of the stock is going to fall down. So you sell first at the opening or beginning of the day. Let us assume the price was 100 rupees. That's that particular day. So you sell at 100 and you buy back at a price like you're pretty sure that the price is going to go down. At 100 you sell, and when the price reaches 99 or 98 rupees, you buy back. So you sell first at 100 and you buy back at 98, and the 2 rupees is your profit. Okay, you'll be having this doubt why how are you able to sell something that you don't have in hand? Okay, the reason is that in the stock exchange the trading hours are 9:15 to 3:30, right? However, the settlements happen only after 3:30 after the market closes. So at the time of settlement, when they look, you have sold 2 quantity, you have bought back 2 quantity. That is minus 2 plus 2. That is at the end of the day, for day trading, your net quantity is 0. That means you can short sell. Like the phenomenon short selling is basically you're borrowing. Punjab National Bank case, okay, like the price is going to fall down. So what you do is you basically borrow the stock from someone else who has, you sell. Let us take an example. Punjab National Bank. There is this friend of mine who has 100 shares. Okay, so I borrow his 100 shares. I sell them at 100 rupees. Then I buy back those 100 shares at a lower price at 98 rupees. So 2 rupees is my gain. 2 into 100 is the profit that I gain. So at the end of the day, I give back the shares that I have borrowed earlier. So basically that it is. However, in the stock exchange, you're not going to borrow from your friend. You can directly place an order through your broker as short sell 100 quantity. It will short sell 100 quantities, and you can buy back at a lower price. If you don't buy back at a lower price, you'll be having to buy. If the price, you are assuming the price is going to go down. So if the price goes down, you can buy back at a lower price and book profits. But if the price is going to go up against your speculation, you'll be in loss. However, like whenever there is a really, really bad news associated with the stock, for example, DHFL, okay, just mark down DHFL, Jet Airways, Punjab National Bank. Just have a look how this stock behaved to negative news. So whenever there are such Yes Bank, so whenever such negative news have happened to these stocks, it has definitely fell down. The price has decreased. So they are like short selling opportunities. That is, you sell first and buy back at a lower price. So that is the concept of short selling. So that is only possible for traders for while trading equities, while trading futures, options, all these things. Like short selling is only possible if you are a trader. If you are an investor, you don't have that option. Just you can sell only something that you have in hand. That is your speculation is that the price is going to go up, the stock is going to perform good, the company is going to generate profits, and the price will go up over time. Okay. Is it compulsory to buy back in short selling on the same day? Can't we keep the trade open for more than a day or two, waiting to hit the target price? Okay. So when you're trading equity, it is compulsory to buy back the shares in short selling. Okay, that is, if you don't buy back by yourself, your broker will buy the shares back. Like at 3:15, if you don't buy back by yourself, your broker will do the process for you. Okay, your broker will do that for you if you don't buy back 350. It is compulsory in the case of equities. However, there are things like instruments like futures. Okay, we'll be coming to those topics much later. Okay, after strategy related equities and all, like there are options in like there are possibilities in futures where you can short sell first and you can buy back. You can sell the future contract and you can buy back the future contract before the expiry. In that case, you can hold on. Okay, so those concepts will be taught later. Like let's not get complicated. In the case of equities, if you're buying today, you need to sell today itself. That is, if you take an intraday trade with one quantity today, you need to sell it off before the market closes, or else you should take a delivery position of the trade. Delivery position means okay. One thing I missed out: two types of trades. Intraday, two types of positions: intraday and delivery. In delivery, in the case of delivery, is the one you look forward for investing. That is, you look to keep hold for 1 week, 1 month, 1 year, 10 years, lifetime. You take a delivery trade. Okay, that is, if I buy one Reliance share under delivery, that stock gets registered under my name and I store it in my demat. However, if I'm just looking for trading, that is, I take one position with a position of intraday. I buy one Reliance share, so I should sell the share back before the market closes at 3:30. If I don't do myself, my broker will do that automatically at 3:50. So best practice is you do it by yourself because the broker will charge you extra for squaring off automatically. Okay, and if you're short selling, you're selling first, and before the market closes, you need to buy back. Okay. So I guess you have got some insights about trading and investing, the difference. So investing is trading in the long term, and trading is like 1 day, 5 minutes, 10 minutes. You whatever is the time frame that you look to stay invested. Okay, that is when you enter the trade, you exit the trade quickly as soon as your speculation is achieved. That is, you speculate the price is going to move up, you buy. You speculate the price is going to move down, you sell first, buy at a lower price. That's it. But in the case of investing, you invest your money, you wait for dividends. That is, you look for profit shares. Okay, you look for profit shares. You look for bonus, or like maybe they'll give you extra money, extra profit shares, or the stock will split. Stock bonus. Stock bonus means like additional stock bonus means like suppose like there will be some announcements like company is doing good profits, and all Reliance shareholders who are having 10 shares will get one share as bonus. That means all the people who had 10 shares early, they'll be getting one free bonus stock, and now they'll be having 11 shares. So all those things are related with investing, not with trading. And for trading, you need a demat plus trading account. So right now, all these demat and trading account are both combined together, and hence we generally take the term demat itself. Okay, so demat is basically used. It's not demat account is full form is dematerialized account. That is like if you buy a stock, the stock gets registered under your name with your PAN card details, with your address, bank, everything, all details. It gets registered. This is actually like you store your money in your bank account, right? So similarly, you store your stocks in your demat account, dematerials account. That's where you store your stocks that you have purchased. Not for day trading. When you day trade, you need a demat account, but then you're not storing it there because you square it off before the market close. Okay. 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 So some of you have already been trading and you have some demat accounts. It's perfectly fine. So if you are a person who is going to start right now, like I suggest you to go for brokers Upstocks or Saroda. Like I personally use Upstocks because I'm a partner with Upstock. Like I have a partnership with Upstocks. Plus, like my dad has some authorized dealership with Saroda as well. Okay, so but I will suggest you to go for Upstocks. The reason is that like their platform is much more faster than Saroda. Saroda is good for charting. Like Kotak Securities, Geojit, their platforms are also good. really good. Okay, their platform is good, their trading platform is good, investing platform is good, the charting tools are good. So as far as the trader is concerned, the most important thing for us is the trading platform. Okay, that is like we need to be able to see the charts good. We need to be able to observe great charts, all these things. Okay, and another important thing is the brokerage charges. Okay, and Upstocks and Saroda, they're basically discount brokers, and their charges are much lower compared to Geojit and Kotak Securities. Okay, charges are lower in the sense like brokerage charges is 0.01 percentage or rupees 20, whichever is lower of the capital that you are using. Okay, so if you have not started a demat account till now, like I suggest you to start one with Upstocks or Zerodha. Go for Upstocks because Zerodha. The issue is that Zerodha has done a lot of advertisement. Like they have a really good charting facility, but then their servers crash most of the time. That is, if you place an order, it'll have some delay for pushing the order to the market. While Upstocks is being backed by Tata and it doesn't have that much members, but like the platform is like really good. Charting facilities, like features and all, like there are more features in Zerodha. But then for trading purpose, I personally use Zerodha for charting. That is for observing the graphs, all these things. But I trade on Upstocks because Upstocks, like the trades gets pushed much faster. The servers are faster for Upstocks. And coming to the brokerage charges is the same thing for Upstocks and Zerodha. And if you want to start an account with Upstocks, I'll share the link. The account opening is free. If you use my referral, the account opening is free for my referred clients, and you get a free stock as well, some 100 rupees stock or something. It doesn't matter. So I suggest you to go for Upstock. If you have Kotak Securities or Geojit, that is like really good. Like as compared to Upstocks and like similar. Okay. However, the brokerage charges are a bit higher. It is 0.03 percentage for Geojit and Kotak Securities, like 0.03 percentage for trading. Okay, and that's it with DMAT. So it's entirely up to you to choose your DMAT broker. But the things that you should look is the charges, the platform, the platform, and the charting thing, and how fast the servers are. Okay, Saroda, this is like really good like till 1.5 years back, but then now it's like very slow. So personally, I don't suggest anyone with Saroda. It's okay to have an account. It takes like some 500 rupees something for registering. And whichever demat account you're having, you have annual maintenance charges also. Okay, Upstock some 300 rupees or something. So if you are a person who is going to start for the first time, go for Upstock because account opening is free and their services are good as well, like really good. Charges are also low. Okay, and okay, so now like we'll wind up the session soon. So before that, like some points to remember, we'll be emphasizing on these things. Discipline, that is like you need to stick to the strategies and your risk management thing. I told you that the risk appetite varies from individual to individual. That is, you should do a self-assessment first. Okay, how much risk can I take? You'll be starting with very low capital. That is, even if you're a person who earns a lot of money, we'll be making it like if you or if, once you start trading with us, like we'll suggest you to start with a very small capital. Okay, then you need to be a bit consistent. That is, even if you're not trading. Okay, so it's not possible to trade every single day. Okay, I personally don't trade every day. I trade like maximum 1 or 2 days a week maximum. Okay, so even if you're not trading, you should have a look at the news. You should look how the markets are moving. Okay. Okay, so we were talking about this news, how news affects so rainfall, price of fertilizers, and automotive industry. Okay, do you know that most of the people in the rural areas they prefer the two wheelers, and most of the people in the rural areas their income is based on farming. So if farming is bad, the profits will be less, and hence less income to buy automotives. Gold USD, like gold and US dollar are like the biggest investment assets people use. That is, if the you must have observed if the price of US dollar goes down, the price of gold goes up. If the price of gold goes down, the price of US dollar goes up. Like they are related inversely. Okay, crude. As the price of crude increases, the price of petrol increases. If the price of petrol increases, everything, transportation requires petrol, diesel, and hence the price of everything increases. Okay, to size to observe. Okay, and coming to the strategies that we'll be going to teach you. So basically, the strategies that we are going to train you. See, there are thousands of strategies available in the markets. Okay, and all of them won't work under the present conditions in Indian markets. So the strategies that we are going to train you are based on the back testing that we have done. Okay, our personal experience. So we have back tested on the prehistoric data, and based on that, the strategies will be trained to you. Okay, so at first we'll be sending you some more videos, and we'll be asking you to analyze the strategies for like 2 weeks. Okay, you'll get comfortable with the strategies. You'll be sending us reports, mostly the support resistance levels. Okay, so based on that, you'll be analyzing for 2 weeks. Okay, and you'll be sending us reports. If there is any corrections, we'll be forwarding you. Okay, so that is how we work. We'll be having a live sessions on strategies. However, to get you more comfortable before attending live, we'll be sending you the recorded videos so that the second time you attend, you'll be very much clear with the concepts. Okay, and this is not an overnight thing. Okay, so it requires a commitment, but it's totally worth it. And right now, the India market, the situation is very much easy because it's easy to get ahead of the 90% gamblers. Okay, so make use of the opportunity. Like we'll be adding you to chat groups as well. Like we'll be adding you to our chat group based on your membership program. Okay, so and in the chat group you'll be seeing people making 10k, 20k profits a day and all. So one important thing that I tell all my clients is that just understand that you should never compare your first day in the markets with somebody else 100th or 200th day. Okay, so they have been doing this from quite a long time. They have been members with us from quite a long time, so they are making bigger profits. Okay, so when we are starting, we always start with a small capital. We need to get comfortable with the strategies. Even if you're getting making profits with small amount of capital, one common mistake most people make is that like we tell people to start with a capital of like 1,000 rupees or 2,100 rupees, anything. You can start trading with any capital. Okay, so if they are making, let us we have this. We usually college students. Okay, so they make like profits with 3,000 rupees capital. So now what happens is that they feel okay, they are very much comfortable with the strategy. Then directly from 3,000 rupees capital, they switch to 30,000 rupees capital that they have borrowed from their friends because they feel okay, they might be making money with the 3,000 rupees, but suddenly they switch to 30,000 rupees. Now what happens is that this money has been borrowed from their friends. Okay, market behaves differently in different capitals. So till you get comfortable with the market under different market conditions, you should never increase the capital. That is, if you're increasing your capital, if you're increasing your investment, increase it step by step. Don't directly increase your capital like 10 folds or 100 folds. So that is one common mistake that people make. So if you're trading with 1,000 rupees, strategies will be the same, but then your risk management, leverage, all the things you need to change while switching to greater capital. Okay, so learn it slowly. Okay, so I'm telling you this because like after today's like today or tomorrow we'll be adding you to chat groups. In the chat group like people will be discussing about trades. Okay, people will be discussing about trades. Like people from the same membership, people with the same mindset. We'll be discussing about trades, personal trades, risk management, news, market news, all these things. Okay, so when you see people making huge profits, don't get excited, don't get too excited, and uh, start off with great capital, big capital. Okay, start with small capital, and for the first 2 weeks, anyways, you people are not going to trade. At least for the new members, like you are not going to trade because you're just going to observe using the strategies that we are training you. Okay, so I guess then one more concept, the last concept that we are going to discuss is the concept of leverage. That is, while day trading, you get this advantage of using leverage. That is, if you have 1,000 rupees in your demat, okay, if you have 1,000 rupees in your demat, now you'll be. I told you that you can start with a capital of 100 rupees as well, right? So you'll be asking, okay, how many stocks are there whose price is 100 rupees? Okay, so the thing is that if you're using leverage, there's a concept called leverage. So leverage is a loan that your stock broker gives you to trade. That is, if you have 100 rupees in your demat, if you are using a broker like Upstocks, you can trade for stocks. You can actually trade for 100 into 20. That is, you can trade for 2,000 rupees with just 100 rupees in your demat. So the reason why your broker is giving you a loan is that if you have, let us assume the price of a stock is 100 rupees. Okay, so if you're buying one with 100 rupees, you'll be able to buy only one stock. Okay. So maybe the brokerage you'll be getting will be like 0.001%. That is 0.001 rupees. 0.0, yeah, 0.01%. Okay, that is 0.01 rupees of 100 rupees. Now he is going to give you into 20, that is 2,000 rupees loan. 100 into 20, 20 times leverage, 2,000 rupees loan. Now you'll be able to buy 20 stocks. So now you will be paying your broker zero point 0.2 rupees. So from 0.01 rupee, he is getting 0.2 rupee brokerage. So that is why, like, brokers with money, they'll give you leverage. Like Upstocks is being backed by Tata, and obviously they have a lot of money. So you'll be getting like 20 times leverage. So the thing is that by using 20 times leverage, let us take this example. The price of the stock moved up from 100 to 101. If you use 20 times leverage, you'll be getting one rupees to effectively your profit, but then your net profit will be 1 into 20. That is 20 rupees will be your profit because you use 20 times leverage. Understand? You have just 100 rupees in your demat. Okay. The price of the stock is 100. The price moved up from 100 to 101. Your price moved up from 100 to 101. Now, what has happened is your profit is 1 rupee, right? But since now, if you use 20 times leverage, you will be able to buy 20 stocks instead of one. So, 1 rupee gain is 1 into 20, 20 rupees profit. Understand? So, net you will be getting 20% profit with 100 rupees investment. So, 100 becomes 120, 20% profit. Now, think the other way around. The price moves down from 100 to 99. 1 rupee loss. If you use 20 times leverage, your loss will be 20%. Things can go the other way around also. Okay, so that is the concept of leverage. So from the next session, we'll be dealing with support resistance levels. Before that, I'll just show you how a demat platform looks if you haven't seen it yet. If you haven't opened the demat, I suggest you to go for Upstocks. Okay, so this is what your platform will look like. You'll be having stocks over here. You'll be having a watch list over here. You'll be able to see stocks over here. Okay, so based on all these are some indicators. Your plain graph will look like this. So these are something that we use for strategies. Okay, so this is the plain graph, how it is going to look. Okay, so with that, Upstock has 2FA setting before logging in. Yes, two-factor authentication. What happens when it's a loss? See, when it's a loss, Bijoy, like that's what I said. Like if you're losing one rupee, if you're using 20 times leverage, you're buying 20 stocks, right? You'll be losing 20 rupees. That is, you're losing 20% instead of 1%. Okay, so If you're using leverage, your risk exposure is also increased. However, we'll be teaching you this risk management. That is like you'll be looking for targets of like 0.5 percentage. If you're okay, basic example, you're looking for a target of 0.5 percentage, 20 times leverage. Your profit is 10%. The risk, the stop loss that you're setting is 0.3 percentage. Okay, 20 times average, 0.3 into 26% is the risk that you're taking. So still, if you're performing, if you win, you get 10%. If you lose 6%. Okay, and if you're performing two trades, one winning and one losing, still you'll be getting a 4% net. Okay, and our strategy, as I said, like you'll be getting like 7 out of 10 winning trades easily. Okay, so with that, we'll wind up the session. Like, may I know if you have any further doubts before winding up? It was a very long session. Like, I guess most of you are tired. I hope it was informative for you. Okay, so how did you find the session? If you don't have any doubts. Like, do you have any doubts? Yeah, recorded version will be sent to you. No issues. It'll be available as a on-demand webinar. Okay, so this was the first introduction session, and we are done with the introduction session. You'll be getting the on-demand webinar. That is to this platform itself. I'll send you the link. Okay, you'll get the link and you can watch the session as per your convenience. It's sent to you like tonight itself. Okay, so I guess we'll wind up for today. Thank you. Good night and happy weekend. So we'll be adding you to chat groups. Thanks. So if you have any queries with the things that we discussed today, okay, I'll be sending some more videos for you guys to have a look at. And once you see those things, like you'll get a much better understanding. Okay. So I'm going to end the session right now. So I guess it's fine for everyone. Okay, then good night. Bye.